this is MrChris. In today's video, I will talk about one of the risks of trading the wheel strategy or any other strategy that includes selling covered call options. Just look at how the market moved within the last month. S&P index down by 7%, Dow Jones down by about 7%, and Nasdaq Composite Index down by 10.5% for the past month. As you are probably aware of, the stock market has been tanking recently. Due to this, all of my cash covered put positions have been assigned except for one, which is the 20 contracts on cash covered put option on QBTS with a strike price of $5 and an expiration date of March 14, 2025. The wheel strategy works best in a sideways market or when your stock just stays within a given range of prices. It also works okay with an increasing stock market. However, as the price of your underlying stock goes up, then the amount of your reserved cash needed to cover your put options also goes high. I traded the wheel strategy starting July of last year, and I have survived the down market last September 2024. And during that time, most of my cash covered put options were also assigned. Fortunately, that September 2024 down market was short-lived. Hence, prices start to come back up quite fast, allowing the option premium to go high, and when my covered call options were assigned, I recovered all of my cost. The same thing is happening this time around, except that the level of market movement is quite significant, and so I am not able to find covered call options at a strike price equal to my cost. And this is one of the risks of trading the wheel strategy. The price of the stock can drop way below your cost, that you are exposed to losing value of your stock, and at the same time not able to sell covered call options at a strike price equal to your cost. So what are the type of actions that you can do when the price of the underlying stock drops way below your cost? There's basically, in my mind, just two actions that you can do. One, stop selling covered call until price of stock increases at a level where you can earn a decent premium at a strike price equal to your cost. And the second action that you can do is to sell covered call at a strike price lower than your cost to earn a decent amount of premium and take the risk of losing if the covered call option is assigned. For example, let's say that the cost of a stock XYZ is at $10 per share and you have 100 shares of XYZ. And let us say that the price of XYZ drops to $5 per share and that the option chain for XYZ shows you that there is no interest in trading covered call options at a strike price of $10. But you can earn a decent amount of premium if you trade at $6 strike price. The problem in trading a covered call option at a strike price of $6 per share is that the price of XYZ could possibly go up above $6, and when you are assigned, you would lose $4 per share minus the premium you earned. So my recommendation is to never trade covered call option at a strike price below your cost unless you want to exit the wheel. Now this week I encountered this situation when the actual price of the underlying stocks that I use for covered call options went below my cost, and I was not able to find any covered call option that had decent premium at a strike price equal to my cost. I have to make a choice on how to deal with this significant drop in the price of the underlying stocks. As a side note, the drop in value of the underlying stocks are just paper losses. So if you sell at the current price or get assigned at a strike price lower than your cost, then you will surely realize that loss. So again, my recommendation, never trade covered call option at a strike price below your cost unless you want to exit the wheel. Now let's take a look at an example from my portfolio. Consider Joby. I have 6,000 shares of Joby with a cost of $9.50. Current price is $6.03. Without any news about Joby's financial conditions at this time, its liquidity has dropped off and I am not able to find any option contract that will provide a decent amount of premium at a strike price of $9.50. So I am not able to sell any covered call unless I sell covered call at $6 strike price where it still has decent open interest and decent premium for covered call options. Also, I can't find and will not sell covered call option at a strike price of $6, way below my cost of $9.50. I'll never do that. Unless, of course, I wanted to exit the wheel. And so, how do I manage this situation? Do I feel bad about this? Do I regret using the wheel strategy for Joby? My answer is no. And this is the reason. Prior to starting trading options on Joby, I used my 6 criteria in selecting stocks for trading options. One of these criteria is that the stock analysts for Joby should have a recommendation of at least a buy recommendation. This is a critical step in selecting your underlying stock to trade the wheel strategy. The analyst for your stocks should at least have a buy recommendation. I followed my 6 criteria in selecting stocks to trade, and Joby was included in my list of stocks that I can trade using the no-loss method of the wheel strategy. When I started trading Joby, it has a strong buy recommendation, and currently it still has a strong buy recommendation from its analysts. Joby is expected to start commercial operation this year and is backed by major companies like Toyota, Jetex, and is also working with the U.S. Air Force. So my expectation is that Joby's price still has tremendous upside, and I expect that its price will go up past $10 per share by end of 2025, and maybe even higher. It actually reached $10 per share late January 25. Under current stock market conditions, the price of Joby dropped way below my cost, and so I decided to just wait. Stop trading Joby until its price is at a level where I can trade covered call option at a strike price equal to $9.50. The impact of this decision is that the total amount of earned premium that I expect to get in March 2025 will be lower than my average earned premium of $17,000 a month. My other option on Joby is that I could also sell covered call options on Joby at a lower strike price near the current price, but this will expose me to the risk of losing part of my capital money. So at the end, I will just wait till the price of Joby increases to a price close to my cost of $9.50 per share, or to a price where I can find covered call option at a strike price equal to my cost, but at an expiration date that is 2, 3, or 4 weeks in the future. Several underlying stocks in my portfolio perform similarly to Joby. This is expected because of the broad market crash, and hence my monthly earned premium will be down this March. As of today, March 11, 2025, I have only earned close to $6,000 of earned premium. And like what I said earlier, most of my positions are in the covered call bucket except one. My current projection is that my March 2025 earned premium income will be close to $8,000 to $10,000 this month, March 2025. With the April monthly earning, I think it would also be lower unless a major market turnaround occurs by then. With this drop in the prices of the underlying stock, my average earned premium for the month of March can be as low as 50% of my average monthly earning within this last 8 months. The no-loss method of the wheel strategy is a good way to earn retirement income, but make sure that you are aware of the risk you are taking when using this strategy so you can properly mitigate this risk. To summarize, when trading the no-loss method of the wheel strategy, and the price of the underlying stock goes way down your cost, I recommend the following. Never trade covered call option at a strike price below your cost of purchasing the stocks. Just wait, the market will turn around. Look for covered call option at a strike price equal or greater than your cost with expiration date of 2, 3, or 4 weeks in the future. And the stock you use to trade the wheel strategy should have a buy or strong buy recommendations. That's it. If you like this video and any of the videos in my channel, please hit the subscribe and like button and ring that bell. If you have any comment or question about the wheel strategy or my perspective on high yield dividend funds like YieldMax, Then write your questions in the comment sections and I will try to answer them the best I can. This is Mr. Chris and thank you for watching.